Now here is something that's so important is, hedging, okay? And so I'm going to show you a couple examples here of what I call hedge trading management using the butterfly and the condor. So this was one that we had set up. This was a QQQ put debit spread that we had. So we were going to short the market using the QQQ, and we did it starting out with a long put debit spread. And then we were able to adjust it. This is what I'm constantly looking for. We were able to adjust this to a no cost free trade where we had zero risk. Okay, so here's kind of stepping you through the trade here. It was trading at 365 right here. So our momentum indicators, we had a cycle reversal, momentum was going negative. So the trade setup was based on looking for a breakdown. And then we had our target, always have a target area. Here was our target area was right here, this 355 area right there based on some fib levels, et cetera. A lot of different things we'll look at. So set the 28th and then made an adjustment on the 1st. At that point, we were able to adjust it to a free trade. And I'll show you how that happened. So it came off hard down here. When it was off hard, we sold against it a bull put credit spread, and that made the trade into a butterfly, and you'll see how it worked. And so then we had a profit take. It was trading at 354. See, this trade was perfect, 365 to 354. And then on expiration, it was max profit, and it was trading at 359.67. So let's walk through the structure. I'll show you how it worked. So the first trade, I broke it down by trade one so you kind of follow. So it's trading at 359. We're going to go short, okay? So trade one, we did a put debit spreads for a move down. So we 6 October, bought the 364 put, sold the 360. So we had a put debit spread like that. All right, now the trade, then the market went down. So this, though, our risk on this trade was $121, okay, $1.21. So that was our max risk, $121 per spread, okay, if you did one spread. The spread width here, it's $4, right? 364, 360. So $400 wide spread less the cost. So this had a potential really nice return of 279 per spread or 230% return. So risking $1 to make 230. Now what's been happening, or what happens a lot, is you'll get a big move, but then you'll get maybe a snapback. So what we'll typically do is when we get a big move down or up, we'll take some profit, or if we can adjust it to a no cost or less risk trade, we'll do that. All right, so that's what we did on this one. So trade one, it was trading at 359, and then when we originally set it up, it was trading at 365. Now it was trading down, it collapsed, and we did trade two. It was trading now at 354. Okay, so when it moved down hard, we were able to sell using the same expiration series, the 6 October. A bull put credit spread, the 354, 350 credit spread, and brought in $141. Okay, so here's our free trade. Then we had the original trade, the long 364, 360 put, cost us $1.21. When the market went down hard, we sold an out of the money bull put credit spread, selling the 354 put, buying the 350, brought in $1.41 credit. So now we had zero risk. We actually had a credit of $20. So we turned this trade in. So if it went up or down, we'd still make 20, but if it goes out anywhere in here, we have a potential huge profit. So on the first, then it was trading out at 354. So our profit was up. We had $152 plus the credit of 20. So this was up $172 per spread. And then on the 7th, it was trading right there, max profit right inside of that profit zone. So it was up $420 on zero risk. So that's the beauty of that. So those are things that you can do. We're constantly looking at. All right, so our trade had zero risk, potential to make $420, and our at risk was nothing. We actually had a credit.